This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. Hello, I've headed over to ABAX Investments in the lovely Cape Town sunshine to chat with Rashaad Tayob, portfolio manager for the Nedgroup Investments Flexible Income Fund. Thanks for joining us today, Rashaad.
Thanks, Rob.
So, hot off the back of the recent budget, I'd like to initially get your thoughts on that, as it doesn't seem like there's much more information for us to use in portfolio construction.
Yeah, so optically, if you look at it, we had the medium-term budget last October. The numbers that they've presented in this budget looked almost the same. So on the one hand, you could say nothing's changed. But actually, there is one fundamental change in that in the last decade or so, what we've consistently done in South Africa was increase taxes and increase spending. And this is the first budget we've seen where there's an attempt to rein in spending. Now, whether that materializes because they've penciled in 160 billion of cuts, primarily through the wages, the thing that we're looking for is whether they're able to execute on that. They've stated their intention, but it's really up to the negotiations and the unions to see whether they can get those cuts through. Now, those are not actual cuts to salaries, they're just reductions in increases, but obviously there's a lot of noise because it's a negotiation and unions are going to try and play hardball, and we're going to have to see whether they can deliver on the budget they've actually presented.
And you said there that we've seen a consistent increase in taxes over the last 10 years, but was it a bit of a surprise this time that there wasn't that much more?
Well, we've seen consistent increases in tax rates. Now, because the economy has been so poor, the increase in revenue from those tax rate increases hasn't actually come through. So we've actually increased rates. The marginal tax rate's gone from about 39, it went to 41, 42, and then now it's sitting at 45. So, but the revenue you've generated from individual taxpayers in real terms has not increased. So the last 5 years of tax increases from the normal taxpayer hasn't actually come through in revenue because they've just been under pressure. You've seen reduction in number of taxpayers. The earnings hasn't come through. So it wasn't actually that difficult a decision not to increase taxes because the taxpayers tapped out. You could have increased the rate, but you wouldn't have gotten any money out of it. We've reached the end of the Laffer curve, is how economists would describe it.
Okay, thank you. And then if this imbalance of a lack of increase in tax revenue versus the increase in spending, whether that's through the wage bill or through our commitments to SOE debt, that's not painting a great picture for the country or the economic or the fiscal budget going forward.
Yeah, so if you look at projections, the MTBPS put us on a debt trajectory where we're going above 60%, 64, 68, and even up to 70 within 3 years or so. The budget that we've seen now still sees us on a trajectory to a 70% debt to GDP ratio from our current level of around 60. So that debt trajectory is still a serious concern for us, and it still means that the issues are not resolved. We are going a different route. Tito Mboweni has been, he's tried to state out loud that, look here, this is not austerity. And what we're trying to do now is actually rein in spending and try and get confidence up and trying to get growth up, because at the end of the day, that's the only way we're going to be able to get out of this debt trap which we're walking into.
Right, okay. And actually, though, if you look at the real yield that you're earning on South African bonds relative to all the other countries or issuers around the world, actually it's quite an attractive place to invest if you're a foreign investor.
Yeah, exactly. I mean, global yields have reached new lows. Globally, we've gone back. European yields have headed back to their seriously negative levels. US Treasuries hit a new record below 130, and in fact are now sitting around 1.1%. So that is an all-time low on US Treasuries, and the market is pricing 100 basis points of cuts from the Fed. So we've got aggressive easing being priced in that type of environment. If you're delivering a 9% yield on 10-year with inflation around 4.5%, that is a relatively attractive proposition. But the important thing is, do we have credibility from a fiscal perspective? If we can deliver that in the next month or so, I think our bonds will be looked on quite favorably at these type of levels.
And is that part of the reason that you've increased your exposure to SA government debt within the portfolio?
So with yields close to 9% and having popped above 9, we have taken the positive view. If you look at our fair value on bond yields, we're seeing them closer to the 8.5%. So we always felt that, yes, there were downside risks, and I think we've been very clear about that. If you look at the roadshows we've done over the last few years, we've actually been, one could accuse us of fear-mongering, the negative picture we've presented on South Africa's fiscal position. And we do believe that there are some downside risks, but on balance, bonds are slightly cheap, and we're happy to add some exposure at these type of levels because we think that there's sufficient bad news being priced in. However, the duration on the portfolio at about 0.75 on local bonds, it's not, I don't believe it reckless. We do have some currency exposure to offset that. So overall, I think we're in quite a balanced position with the duration position, with a bond exposure of about 12%, offset with that with a currency position about 5%. I think it's a relatively neutral position, and we will, if we do get a worst case scenario where bond yields kick up 100 or even 200 basis points in some sort of debt crisis, which could materialize in the next year or two, I think we protected against that. And also, we are being quite tactical. Immediately after the budget, we saw a bond rally, and we sold, about 2 or 3% of that bond position. And then on Monday, we bought it back. So I'm sorry, on Friday afternoon, we bought some of that back. So we are being a bit tactical, and we do think that the market volatility will present us with opportunities to do that.
Talking of negative sentiment, you hold some Eskom debt within your portfolio. Would you just put people's minds to rest about the fact that debt is actually fairly secure, and why is that?
Yeah. So the debt we've held in Eskom is a combination, the majority of it is government guaranteed debt in the 2023 area. So we think that we're getting basically a 200 basis point pickup over money market for a relatively short asset, which has a very strong government guaranteed under a local DMTN program. We spent a lot of time assessing that guarantee, looking at legal opinions, etc. And that, we believe, is as solid as you can possibly want. So we're very happy with the government guaranteed debt on a shorter term horizon. And then secondly, we do have a position in the unguaranteed debt. The majority of that is got less than 1 year to go, and we're getting about a 400 basis point pickup on that type of exposure. So now you're talking about an 11% effective rand yield on something which is less than 1 year, when money markets yielding, at this point, 7%. So we're getting a great pickup there. And if you look at even in the recent budget, it was re-emphasized. Eskom has cash injections of over 50 billion for the next 2 years, and then 23 billion going forward. So on a 1 year horizon, we are very confident that there's not going to be any issue at Eskom, and the issues could still materialize down the line. But in terms of our unguaranteed exposure, it's very short duration, and we're getting an excellent yield pickup on that.
That's great. Thank you very much. And just like to tease out your views on the rand, especially after the last week or so, where we've seen the rand weaken significantly in the risk-off territory that we've been in. At the end of the year, you were saying the rand was overvalued because it got down to slightly below 14 against the dollar. Now we've pushed out to 15.50 as of today. So what's your views from here?
So when the rand got to 14, I think we were very clear that we believed it was overvalued. So on a valuation perspective, and I think a lot of people had said, when they just look at pure valuation, you're getting around 14 or sometimes even 13.50 to the dollar as a fair value. However, we don't believe that you can just look at a valuation metric. You have to look at the fundamentals. And the metrics that we choose to analyze the fundamentals on a relative basis to the rest of the world are the fiscal deficit, the current account deficit, and relative growth. And on two of those metrics, the fiscal deficit and the current and the relative growth, we are doing very poorly. Our growth is stuck below 1%. Our fiscal deficit is blowing up, close to the 7% level. We are looking very poor relative to the rest of the world. And that's why we believe that the rand should trade relatively cheap once you do the fundamental adjustment. And that puts us around the 15.50 level on a fundamentally adjusted fair value. So we think that the rand has now depreciated to what we believe is a fundamentally adjusted fair value. We think it's around the right level at the 1550. But in this type of environment, we think that it can even move a bit cheaper. So we from being pessimistic on the rand at 14, we now relatively neutral on the rand at 1550.
So it sounds like you won't be changing any of your offshore exposure on the back of recent moves.
So what we could do is, and you've seen this at previous times, is when the rand blows out, we look to add currency overlays, option hedges in place, such that if the rand rebounds, we're not negatively impacted. Now, we're not there yet. We don't think that the options market is pricing in that sufficiently. We don't think the rand is necessarily cheap. Previously, we did it when the rand hit around the 16 level. We put a lot of protection in place, and that actually protected us as the rand strengthened. But it's a tactic that we are looking and closely monitoring and pricing in the last week as the rand's been depreciating.
Okay, thank you. Nedgroup Collective Investments is an authorized collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.